think what's tough on on our end is the uncertainty, because I don't know. I've got some really good friends that are attorneys that have read this thing, a lot of times, and I think the overall look on it is it's a fairly poorly written piece of legislation as far as timing and things like that. So, but what we all know is you're going to take reimbursement and you're going to do this. So getting the same out of the other end is going to be probably going to be volume driven. And I think in doing that, like for us, is the economies of scale you get with a bigger firm that has a little bit more horsepower than we do, is a good thing. And they also have I think the pieces in place to anticipate, because they have people working on, DC and what's going to come out of that law. Because really, no one really, I don't think you can talk to anybody that says it's going to be this. I think the main thing I've heard is that that we've talked to consultants who've read the thing, is just, I think the only thing you can be sure of is that no matter where you're at on the socioeconomic ladder, okay, as a consumer, you're going to be fairly surprised at what what you can get, and I mean that, and probably it'd be a little bit downward shift from what you think you're going to have, and no matter where that is, and that's not it's not a knock on it. I think it's just the way it is, and we also don't know that the volume that is by trying to get everybody insured, whether that's going to translate or not, because right now it's easier for folks to say, if I don't want it, I'll take the fine.
Most serious thing I was sharing with somebody earlier, I say most serious, just where people have gotten upset and noses out of joint, has been a valuation report that we did here not too long ago for a small company, 2 partners, 50-50. The elder partner is 60, 61. The younger partner is probably about 47, I'm thinking. And the older partner is starting to think about how he wants to phase out of this business, and so he's trying to come up with a plan. And one of the things that they came to us and asked us to do is go through a valuation on this business. I'd like to sell my interest, and maybe I sell it to my fellow partner, or maybe we find another person to come in with him on this, or something of that nature. And so we went through the process. We did the valuation report. We sat down with them, and I thought his eyes were going to pop out of his head whenever he looked at the number. He was really, really surprised, and not in a good way. And the issue with that, I think, circles back to what we talked about a little bit earlier, which is key executive dependency. In that particular case, these 2 guys are driving this company, and it's a service-oriented company. So they have assets, they have inventory and other things that they use. So there are other components to the business, but this business, the 2 of these guys got together. They've built this business over the last 15 years. They've done a really good job with it. But if one of them walks away, there's a problem. They haven't done anything to set up a transition to someone else. And so one of the things that I would advise, and I would imagine you do as well, is if somebody is thinking about selling their business, especially if it's a business where 1 or 2 people are the spark plugs inside this business, you've got to start transitioning yourself out of the day-to-day operations of that business. Otherwise, you're going to run into a problem with potential buyers worrying about the volatility of those cash flows down the road. And if you're not there, what's going to happen? Expound on that.
What was the original question?
So the original question is examples of big differences in perspective. Talk about your purpose matters around valuation. In the course of selling it, the purpose of an institutional buyer is get the price low. Our purpose is get the price high. What's your most extreme situation of working through a difference in view?
Well, it's like this, like the example I gave at the beginning. We can see a wide range of valuation expectations on the barge company from 16 million to 33 million. I mean, how do you plug that kind of a hole? And a lot of times we you try to run a process, and we try to provide, quote, guidance to our buyers as they're going along. And, up front, they typically say, what are the buyer's expectations? And we typically do, as I said before, we're not sure yet, but they'll be reasonable. Because we want to, and usually we have vetted buyers, to make sure if it's a private equity group that they have a history of not just kicking the tires and walking away, but that when they enter into a process, they're serious, and we know that they have the wherewithal to go get the debt, layers of debt or whatever to close. We have had a situation, having said that, where a group that we thought was had done a lot of deals, and it was a company that was backed by a private equity group. And we go through this process of saying, okay, here's the memorandum, take a look at it. Based upon the memorandum, give us a range of value that you would assign to the company, and then we will decide if we're going to take you to, quote, round two. And these guys, lobbed in a very big number, and we were all excited. So they were part of the mix of going to round two, and then you bring them to round two, and about 2 weeks later, when we asked for an actual LOI process, they basically came back and said, well, we've decided to lower our bid by about 40%. And the thing about it is it wasn't on any new information. And a lot of it was the fact that they had an inexperienced corporate development guy at the helm. And, sometimes when you got that big of a gap, you just got to say, well, just remember that on the next transaction. So it does happen.
Do you have any examples for you in going through the process about sort of set and reset on value?
No, I mean, we wanted the lob thing, the 33 million, but we didn't get that. No, I think on ours, for us, the pre-planning that we did was probably smart, because at least when we went and sat down with Andy and Chris, we kind of knew what a little bit of what we were. We had talked to enough people, we kind of knew the guidelines of the deal, so we didn't come in, I don't think, with, we weren't unrealistic in where we were. And I think that, what Chris and Andy did is kind of helped us get, fine tune that, sharpen the spear a little bit on just, hey, this is probably where we're at. Because, we didn't go into this going, we're gonna make a deal. We kind of went into it knowing that, hey, things were heating up because we were getting calls. And who are we? We don't have anybody. So we have a web page. So we're getting calls, so there's got to be something going on. So we wanted to find out, hey, what exactly is, and kind of through the process, pulled some information that we knew about the market and healthcare and et cetera, and ended up getting with a good, partnered up with a good group. So I actually think that the work we did calling, buddies of ours that have done it helped out a lot, because we didn't have any inflated opinion of ourselves. A little inflated opinion of ourselves, but not a big inflated opinion of ourselves. So kind of helped out. Well, these guys hammered that pretty hard for us. Hey, you got to think what does 6 months post deal look like if you do a deal, and that was important to us because we knew we weren't going anywhere. Our deal certainly isn't isn't something where we're taking money off the table and walking away by any stretch of imagination. We knew we were going to be working with whoever. So we wanted to get a kind of a partner who allowed us to do, to run our business that is now part of their business. So that was really important to us, because I don't know, we would not have done a deal, because that's not something that we were looking for. We were doing fine. We didn't have any reason to sell. We didn't have any. We could have marched on. One of the things was looking for what would we have to do to take our company to the next level. And for us, it was a little bit mitigating risk, is why we even sat down in the process, because I was kind of sick of signing personal guarantees, and we were going to have to get more capital investment to do what we want to do. So we wanted to find out if there's another avenue out there where you can, OPM, other people's money, much easier to spend than yours. So we kind of went that way, as long as we got the right firm, which we did. But we're doing the same thing that we have been doing. We run the company, our neck of the woods down here, and we still treat in the clinic. I mean, really. I mean, from the time, to probably a year and a half where we had gotten a few other phone calls to where, you know, we had talked to actually our counsel and kind of just said, hey, who? And so we had some capital advisory groups that some of our buddies had used in Chicago and in New York, and we had talked to them, and then we sat down with FourBridges too, and we just thought the fit was better. So, but it was a year. I mean, it was, you know, I mean, from close to probably the first time we sat down with them, solid year.
No, the How Ugly Is Your Baby it's a study that we've done. In this case, we didn't, because they already had some people knocking on their doors, and we kind of jumped in. But with all the clients, you know, our time is money as well. So we don't want to get involved in a situation where we're going to be 3 months into it and then find we don't have a deal. So we typically do say that when we're going to get started, and if we feel like there's a go, no go, then we'll be very upfront and stop the process. But that part of that has led to this bridge to value study that we do, and it takes about 2.5 months. And part of that is to go through and some of the things that I talked about, you know, coming back to somebody and saying, hey, you got a customer concentration. We did one for a company not too long ago. The owner's probably in his late 60s, and he said, I may sell in 2 months or 3 years, not sure. But he did want to know how ugly his baby was, and we came back and said, okay, you've got about a 50% customer concentration, and you really can't do a whole lot about it, but recognize that that's going to limit the number of buyers you're going to be able to go to. And he's a $50 million company. What that really means is that he needs to go sell to a $700 million company, because then they don't care about the concentration. It's just another account for them. So we go through that, and then at the end of the day, even call, we'll go through our database and say, find some private equity guys who own a widget company, and call them and just say, look, I've got a client that's doing 50 million revenues. They got a customer concentration for 50%. Won't tell you where they are and exactly what they do, but how do you view the world on that? Are y'all inquiring? And if you do, where are you on the multiple range? And try to dial it down to what those expectations are, because as I think Gary alluded to, they'd done their own market checks to kind of figure out where they might be on a valuation spectrum. And I think that's one thing you find out is a lot of times an owner-entrepreneur thinks that company's worth this, as you were saying too, Randall, and they think that in 4 years it's going to be great, I'm just going to throw the keys and go to Destin because I'm going to have this much money, when in reality, because they got customer concentrations or whatever else, it's going to be more like this. I guess if you looked at our sweet spot, and something that's changed over the last 5 years has been these private equity groups that are out there, and a lot of them have these platform companies, not unlike what Gary just did. ATI is owned by a company, not to use a lot of letters, but they're owned by KRG Capital out of Denver, and they really want to do what they call add-ons to the ATI platform. A lot of private equity groups will say that their minimum EBITDA company that they want to buy is $5 million, but they have no minimums for add-ons. So what that really means is there's a lot of business owners out there who, again, they got the widget company maybe doing $1 million in cash flow, and 10 years ago the only option they had to sell was to call a business broker and just see if they could sell it to somebody locally. They'd probably have to take back a bunch of paper, and sometimes it gets run in the ground. They never get, you've seen those kind of stories. So it's a long-winded way of saying, we'll do deals for companies that are in the 5 to 7 million on the low end of revenues, certainly up to the $100 million level. We can certainly do the bigger ones are easier, but sometimes there's a lot of competition involved in those. In a so-called normal market environment, to get to the final answer to your question, probably 70% of our business is probably going to be sell-side M&A. We do buy-side M&A. We effectively be in the corporate development acquisition side of a business to go help them look for candidates for acquisitions and actually consummate the transaction. We do debt refinancings, and we don't do a whole lot of equity, straight equity. The equity that we would do for companies is typically going to be an institutional raise. We certainly but having said that, companies that are here in Chattanooga, as you know, our partner Charlie Brock's been real involved in Launch Tennessee and a lot of the entrepreneurial work around here, and we really like advising companies and giving them some guidance about how to go grow their companies. We really don't spend a lot of time doing the kind of friends and family raises, though.